and numbers and trying to kind of pigeonhole all of you into becoming valuation analysts, right? Because from the surface of things, that's what it looks like, doesn't it? That's not what it's about at all. You're going to use these metrics in business. Someday, Darion, somebody's going to walk up to you, you're going to be a senior vice president in the company, and they're going to want to have you sign off on the investment in a new part of the company, or a new product line, or a new capital investment, and you're going to have to help, you're going to have to make the decision as to whether or not to do it. And you're going to have somebody in there that ran some numbers for you. But the first thing that should come to your mind, the first thing, is numbers don't lie and liars use numbers. Okay?
Ooh.
Yeah, no, yeah, for real. I mean, we know this, right?
Yeah.
And you say, well, why should that be the first thing that comes to my mind? This is one of my trusted VPs or managers or what have you. And we have to stop and remember that they're human beings, right? And your interests and the firm's interests and their interests are not necessarily completely aligned, right? And so you need to be able to cut through this. You need to be able to ask the questions, because unfortunately they didn't have this class or one like it. Very possibly, right? So you need to be able to critically be able to look at the numerics of the situation. And every situation you can find yourself in business can be boiled down to numerics. Every one. And so you need to be able to boil it down, figure out the numbers, and then think, what framework do I have in the back of my little head that will let me or help me make a decision about this? And we are developing many of those frameworks. We talk about cash flow, right? And we've discussed that there are many different types of cash flows. Well, when you know the cash flow that's relevant to the decision you're making, and when we're talking about the entirety of the firm, that cash flow is free cash flow. But when you know the cash flow that's relevant to the decision you're making, and you know then what it's going to give you, or you have some estimates of what it's going to give you over time in cash flow, and you know what cash costs your company, or investment costs your company, or you as part of your company, you can then go ahead and put those metrics, those values into these kinds of equations, and you can say, okay, this should be worth X to me. And if it's going to cost you meaningfully less than X, yippee. And if it's going to cost you X, take it or leave it. If it's going to cost you more than X, walk away. And it will shock you how many times decisions are made in business where the real cost was more than X. Where the real cost was more than the discounted present value. And it was only because the people making the decision didn't understand how to think about that discounted present value. And whether that's a whole company or a part of the company, or just a decision you're making in terms of accounts receivable collections with your AR clerk, or a marketing program or campaign, or trying to decide, how much do we put in our R&D budget. So these things are completely relevant. We're going to get, in the very last class, we'll talk in more detail about which types of models or equations best fit which scenarios. For example, we're dealing primarily with enterprise value and EBIT, right? And if you think about what we're dealing with, those are really the two most fundamental inputs that we're dealing with. And we're going to talk later tonight about one of the various enterprise value multiples that you'll see is really kind of a way to think about continuing value. And the one I like the most is EV/EBIT. But if Dan and I have a company and we don't have much in the way of EBIT yet, because we still have these massive startup costs, right? And we're not very efficient, then maybe the EV/EBIT multiple wouldn't be all that relevant. Maybe the EV sales multiple would be relevant. Or if we have a company that has really high capital assets, which probably means it has significant depreciation, right? Then maybe EV/EBIT isn't the best multiple to think of, and EV/EBITDA, which is EBIT including depreciation and amortization. So earnings before interest, tax, depreciation, amortization. So it brings in that depreciation piece that was so critical to this business with these huge capital assets. Think about a railroad. A railroad doesn't turn a penny in revenue until they've laid out hundreds of millions of dollars in capital. So try to keep all that stuff in mind as we're going through all the little minutiae of what the inputs are. I know it's hard. You guys are doing fine, honestly you are. I promise you. I give grades, I'm the one that knows. Yeah?
So when we do the NPV, IRR, all that, the whole chart, everything, I was trying to understand. I know how to calculate it, but by looking at it, what number can I look at and be like, oh, that's what I'm getting from my investment?
Got it. Well, sadly, all three of them. But you have to understand how they interact, okay? So the net present, let me start with present value.
Mm-hmm.
The present value of an asset, I don't care if it's one this big or this big, okay? The present value of an asset, is what it is worth to you. It is what you should rationally, reasonably be willing to pay for. That's its value, okay? The net present value of that same asset is its present value minus what you paid for it. So it's net, okay? And if that number is 0, then it means that what you got from the asset over time is exactly what you expected to get, and the discount rate that you, and the rate of return you received is exactly your discount rate, okay? Cool. In which case, I can look at the IRR and know exactly what I got. But I didn't even need to, because if it was exactly the same as my discount rate, I know what my discount rate was. Yeah.
So that's another thing that I'm not sure of. The IRR, I understand what it is. It's the rate of return, I guess, how much you're getting back.
Yeah.
But is that like throughout all of eternity?
It's an annualized value, it's an annualized rate that you received for the period in time that we're assessing.
Okay, so you would get the IRR annually.
Yeah, that would be your annualized rate of return during the period that we're assessing.
Okay.
And if we're assessing eternity, which sometimes we are, right? Then it's kind of eternal.
Okay.
You know, it's a little hard, a little bold.
But in the case of having explicit and I forget and continuation, would it be just for the explicit years?
No, we're going to use the continuation.
So it would include
everything we know.
Supposedly everything.
Yeah, so let's talk about continuation values for just a brief moment, and I need to then come back also to discount rates, okay? So if Adriana and I have invested in something, and Kim comes to us and says, guys, I really think that we need to liquidate this asset at 5 years. We want to exit in 5 years, which is not an uncommon time frame for exit in private equity and VC, right? We want to exit in 5 years or 7 years. We're going to have some kind of a target amount for our exit. We plan to sell it for X, okay? $100 million. That $100 million probably is the continuation value that we estimate today, but it's as of then, right? That's how we decided that we could sell it for $100 million at that point. I mean, if we're just saying, oh, I want to sell it for $100 million, you know, willy-nilly, then we ought to just go say thank you for shopping at Walmart. That's about what we're earning, right? Any of you that work for Walmart, I'm not putting them down, I apologize. I'm not putting them down, Kinsey. Okay. So we have to have some way of thinking about what that exit's going to be. Or let's say we're not going to have an exit. We just know that this is a printing press. And we don't intend to buy another printing press because we know printing presses are going the way of the dinosaur, right? And so we think that in 7 years the printing press will have no functional value, but maybe because it's largely made out of steel and iron, maybe it'll have some salvage value. And we believe because of depreciation schedules, whatever it happens to be, depletion expectations, that this $300,000 thing we're buying today, or we might buy today, probably is going to be worth $8,000 in 7 years, because that's what it's worth when I sell it to the junkyard, right? I get the cash flows in between now and then. Those are during my explicit period, right? But then it gets to the point where it's not worth continuing to maintain it because it's going away with the dinosaur. So we sell it off to the junk man. That's our continuing value. So that's clearly a non-eternity one, right? Mm-hmm. Both of those are non-eternity. But sometimes we don't know when that's going to be. So Harry and I had this great idea, and we put together this company, and we are dead in love with this thing. Harry, if you ever come to me to talk about selling this, it's just, you're not gonna do well. I will tell you, I will make sure that you understand how badly I take that idea. We're gonna have this until our grandchildren are dead. And the only reason we say that is because we know they're gonna pass it on, we just don't know who to, right? So that's one where we're clearly gonna look at a continuation value that we expect actually to just represent the value of the asset we're keeping, but we have to have a finite point in time to do this, because we can't get an IRR or a modified internal rate of return if we have an infinite series of time, right? We have to stop somewhere to be able to calculate it, because we can't calculate on an infinite series of values when we're thinking about a return. You guys did the project investment selection, and I got some really good questions. Unfortunately, more of them on email than on WhatsApp, but I got some really good questions about, by the way, boutiques. And why I think it didn't have an IRR on my solution set. I think it did have an MIRR, maybe something like that, but how did you calculate it? And my response was immediately understood by each of you that saw it, and that was, well, it doesn't give us a return. It never gives us our money back, so it has no rate of return. And people confuse that. People sometimes will say, well, it's just a negative rate of return. Well, maybe you can mathematically say that it's a negative rate of return, but if I know that it's going to be negative, not even a little positive, it's negative, why on earth would I bother spending even another moment thinking about this thing? I know how to lose money. I can open a restaurant, okay? No. We don't have to do this. So modified internal rate of return differ only in how they calculate. And modified internal rate of return, which is by far the least common return measure used, is the most accurate. Because internal rate of return makes a very bold assumption. It makes the assumption that this return that we're amalgamating, that we can continue to get that in the market today. So if we have surpluses, we're taking this surplus and we're reinvesting it somewhere and getting that return. Well, if that's 7%, sure, right? If it's 60, oh please, okay? And so the internal rate of return kind of has this circularity problem with it, but it's the one that's used by 90%, maybe more, of financiers, because they don't even know that it has this circularity problem. So here you are, CJ, you're talking to the people at your company. Where do you work? Pardon me?
McNeil Engineering.
McNeil Engineering. So you're talking to the folks at McNeil, and somebody sitting at the table says, we're going to get a 37% internal rate of return on this. You say, excuse me, I've calculated this, and you're making the assumption that all the surpluses can be reinvested at 36%. I'm telling you, we can't count on anything more than 8%. And when I then put that into the equation, it tells us we're getting an internal rate of return of 11% on this. And our requirement was 13. And all of a sudden, you've gone from being a manager to a senior vice president. And I'm kidding, but only sort of, right? Here's the most important thing I want you to think about, and this is mostly just you. Think about the content and the context of the question you just asked versus your ability to ask a question a week ago and 2 weeks ago. Okay? I want you to think about that. Because you were freaked out, right?
Yeah.
Okay, all right. So discount rates. Wes, what's a discount rate?
It's what you can project the future to, what the future earnings are going to look like today, or the percentage that it changes.
So it's one of the inputs that we would use to make that projection, right?
Yeah.
And it helps us have a sense of, to us, how money changes value over time. Why do we not simply use inflation as the discount rate? I mean, isn't that how money changes value over time? Inflation rates? Sure it is.
That's pretty broad, though. It factors in.
Well, all of these are broad, Harry. Keep going.
Well, like
I never come back at you if you're not headed down the right road.
weighted average cost of capital is like specific to the industry or even like a company.
Well, weighted average cost of capital would be specific to the company. So, Dariana, you're looking at buying Harry's company. Do you care at all about what return Harry's company is subject to, their cost of capital, or do you care about your cost of capital? Remember, this discount rate is only an opportunity cost. This is not an interest expense. We clearly care about interest rates, right? And that's one of the many inputs. But the interest rate we're going to care about, if you hold to a market-based opportunity cost, is the current rate that that company should pay, should get, should have, right? So here, Dariana's looking at this and saying, well, Dariana's part of a private equity fund, and they've consistently been able to pull an average of 32% returns for their clients. That's the number. If you can't do that, or if you can't project doing that, you know there's no sense in continuing the discussion. You've worked your guts out, Harry, to have one of the lowest costs of capital around, because you know that if your return on capital is greater than your cost of capital, you're winning. And she comes at you, and she couldn't care less. She's got a 32%. Which one do we use? Well, they're both relevant, CJ. She's going to think about offering based upon her 32% requirement. He thinks about asking based upon his 11% reality. And unfortunately, unless you're dealing with a very small company with very small cash flows, the number between those two, we can drive a whole freight train through, right? But then we start to whittle it away a little bit. Dariana, in your private equity firm, is it just passive money that you're investing, or do you guys get involved? Do you retain the right to name the CEO? You take a couple of seats on the board, and you're actively working within the insides of this company? Which one is it?
Second one.
Yeah, private equity, and to some degree venture capital, right? They're not just passive investors. They're getting in and getting it done. So now we got to think about her 32% wasn't just because of an asset return, it was an asset and a human capital return. So we can find a way to ferret that out. Maybe her number is really not that much different than yours. So it depends. It depends. But when you got this space you can drive a freight train through, you either have to accept it and walk away because you're never going to find negotiation, right? Or you have to figure out what it really means, because maybe it means something you don't know. Does that help at all?
Yeah.
Is it clearer? Was it clearer 5 minutes ago than it was 2 weeks ago? I think so. And I can tell just by some of the things you emailed to me and some of the answers you're giving and such, I can tell that it is. I promise you, in 2 weeks it'll be meaningfully clearer still. Okay? One of the things that I do, and I don't know that this is good, but I continue to do it, and you're welcome to try to keep me from it, is I try to act as much as possible like you guys are understanding the end, and I keep throwing details at you about the end of something, getting you used to it, rather than thinking that you're babies and feeding you pablum and such. I mean, there's some of that line upon line stuff happening too, right? But I do that, and I think that it's a little harder sometimes in the earliest part to realize what you're getting, but later on I think that maybe there's an appreciation, at least that's what I like to be taught that way. That's probably what I do. Why are you smiling so much? Yeah. He's still hearkening back to my hope that we're getting out of here early. But I want some credit because twice I used his name, and last week at this point I couldn't remember it. Okay? All right. Thank you for asking. I'm not here much this week. I leave tomorrow to go to New York for several days. And I'll be back on late Monday night.
Is it your dinner?
It's breakfast, actually.
Okay.
Yeah, but with Professor DeModer?
Yeah.
In fact, I got a little freaked out yesterday. I called into his office to confirm where we were meeting, and his one of the assistants in the office said, well, Dr. DeModer is on sabbatical. Sabbatical starting in August 17, won't be back for a year. That was My thought was the dog, you know, and he's on sabbatical at his house in wherever it is, you know, Connecticut, as opposed to he didn't go anyplace. But for a moment, I thought, I'm gonna have to get hosed. I don't mind getting hosed by driving from here to the other side of Sugar House, but going from here to Manhattan to get hosed, not so much with that. Anyway, yeah. Anyway, so I'm gonna be gone for a few days, but then Tuesday through Friday, I'm very available. My daytime May term class wraps up tomorrow. And so if you need some time with me individually, or a few of you together, don't hesitate to ask. On Tuesday and Wednesday evening, that's hard for me. Thursday evening I can, and during those daytimes I easily can, okay? And if that's face-to-face, or it's on the telephone, and it's got some Skyping, computering, whatever, if you're still lost, if there's some problems, for heaven's sakes, solve that before that week goes out. Because if you don't, we are on a very fast downward trend to the completion of this deal, and there won't be time to save me, okay? Okay, any questions with respect to the problem set you just did? Project investment selection. To the extent that I saw you struggling on things, I saw you struggling with how do we integrate the continuing value into this net present value IRR deal, okay? Remember that in order to consider an internal rate of return, we must have a finite time frame. So we kind of synthesize that a little bit, don't we? We figure out what this continuing value is. Maybe it's a salvage value, an exit value, something. We know how to calculate it, or we've been given it. And we then have to think about, when is that value as of? So if I have a company with 8 years of cash flow, and I say that at the end of the 8th year, I'm going to go ahead and sell the company for its then present value, which would be the continuing value, right? At that point. Well, I'm going to use the cash flow in the next year to calculate it, but remember that value is as of the end of the 8th year. So I would add the value, as of its 8th year value, to my 8th year cash flow. And that would be the last term in my cash flow consideration for internal rate of return, or for net present value for that matter. Several of you hit me with questions about you're getting numbers that were different than mine, and it was only because you forgot that Excel doesn't understand times zero. You were picking up times zero in the range rather than just adding it as a negative value. Okay? It doesn't understand times zero when it's net present value, and it perfectly understands times zero when it's IRR and MIRR. And I do not understand why that condition persists, because Microsoft knows this. So there's got to be something that I don't understand about it. Okay.
I have a question on
Yeah.
your response to the last question, number 6.
Was I sarcastic?
No,
Okay.
you just asked us to choose which one we
Oh yeah,
liked.
yeah.
I was wondering if you could explain your response on the answer sheet. It wasn't exactly intuitive how you made the leap to adding an extra period and changing the rates. I know that's higher level. Your answer was much higher
Oh
level.
no, I don't think it is. I don't think it is. I think you'll understand this perfectly. Just because we have started these assessments and estimations doesn't mean that they're set in stone. I could look at this any freaking way I want to, right? So, and you may have to correct me here. If I remember correctly, I like Don Treader.
Uh-huh.
I don't like that it's going to bleed $5 million a year for the next 3 years. So rather than fund that out of cash flows, I've suggested that we're going to go to some of our friends and have them loan us money to do this, okay? Because I think that we can borrow money at a lower cost than our opportunity cost of money, okay? So we're going to get some, I guess maybe you can say some exploitation or arbitrage advantage out of it, a little bit, I guess. Okay? So that's part of what I'm thinking about there. But also remember, I wasn't willing to give them what they were asking, because I never paid. Well, when I buy apples at Smith's, I pay exactly what they're asking, right? And unfortunately, too often when I buy cars, I get suckered in all the time. But when it's something real, it's big, I never pay what's being asked. You know, we get down to the them see how they don't really want what they think they want. Right? How it's not to their advantage to take that. And so, so I just kind of worked along. I guess what was maybe more important is why did I like Don Shredder?
Well, you added another period too, so you like, so we add.
Sure. Yeah, it's not so much, yeah. So I decided that if we go from losses to $5 million losses, right? So not insignificant, to a $3.5 million positive cash flow, which that's okay, but it's not until year 4, and then 35% a year, years after year 4 through year 8. I mean, that's cooking with gas, right? And to think that we're going to go from that 35% and just collapse all the way to 8, which 8 for a long-term growth rate is still pretty hot. Doesn't sound all that exciting to you, but that's hot, okay? But to think we're just going to do that, fall off of that particular cliff, I just don't know why that's realistic. And so I added this additional period of time, 4 years, 9 through 13, I think it was, in the explicit period where we slowed our growth down, okay? So the question might be, well, why didn't I slow down the growth in year 7 or 8? Why did I continue to believe the 35%? Because we had a government contract that told us we got it, okay? And so part of my premise was, if we can find government contracts that are that lucrative and if we're doing our job, can we not, over the next 8 years, find some more? Maybe not that as lucrative as that one, or maybe yet more so. So it's just a way of looking at it, to try to justify the number that I was willing to pay. Wes?
So I guess on that, when you're evaluating a company or an investment that you're looking at purchasing, isn't it in your best interest to have that fall off because it's going to devalue the rest of the future cash flows? Or not devalue, but it's going to give you lower future cash flows.
It may be.
Lower total
You know, I
value.
understand exactly what you're saying, because then I think it gives us a lower present value, right? And in this case, and this may not be unrealistic, by the way, this may be something you will often do. We're looking at this from the standpoint of the investor who wanted an 18% return, is that right? What was the number? It was 18? Okay. But we know that the seller is coming at it from a different standpoint, right? So maybe I really like the asset, I want to buy the asset. I'm not willing to pay what the seller wants. And the seller is not willing to accept what I want to pay. So I've got to find a way to see if I can convince myself in the middle that there's a number that might be more palatable to the seller and that I may be comfortable with. So maybe this is part of how you do that. Yeah, you're right, it increased the value over what my initial assessment might have been, but it maybe needed to. Maybe it needed to. Yeah.
Another question unrelated to that. I was just wondering, the present value is usually different to the investment amount. Is proposed investment or...
In the samples I gave you?
Yes.
Yeah, because I never paid asking price. I never paid retail.
Okay. But generally, they would try to ask us for the present value?
Yeah, absolutely. And they might be surprised or even angry that we're not willing to pay it. So they might come back and say, okay, look, let's use your numbers. Cam, let's use your numbers. You said we're going to have these cash flows. You've done the research, you and all your analysts. Okay, forget, we won't use my number because you think my numbers are jacked, right? Okay. So we're going to use your numbers, and you've said all these cash flows, and you've got this discount rate and this period of time, and this way you're going to capitalize the asset, and it came out to $25 million. Why are you not willing to pay $25 million? And I've actually had this very discussion, okay, where it's been asked of me. And my response is, well, yes, I used my discount rate, I did all of these things, but the reality is I'm not really satisfied with my discount rate. I mean, yeah, I'd accept it, but it's not what I want. I want more. Yeah, right. I told you about a guy named Sam Gompers. Sam Gompers, I love that name, by the way. He was the first president of what became the AFL-CIO. So the largest labor union that our country's ever known. And and this is many, many years ago, somewhere in the 1860s, just before the entry into the Civil War, Gompers was put before the House and the Senate, because even labor unions at that point were challenging for the country. And remember, the 1860s were just really in the nascent stages of the Industrial Revolution, and large blocks of workers are now being industrialized, right? And so Gompers is standing for the House and Senate, and they're getting kind of upset, some committee, and one senator says, in fact, he slammed his stuff down on the table, "Mr. Gompers, what do you want?" And he looked at him, he said, "More. I just want more." And then he went on to articulate what more he wanted. We want more. Courtney, don't you want more? Why do we want more? Why aren't we ever satisfied with what's right in front of us?
The human nature.
Yeah, because we can envision things. It's a blessing and a curse. It really is. We always want more. Okay. Anything else?
Yeah, so
Okay.
basically you justify the proposed investment, what you're willing to pay, by playing with the discount rate, by saying, no, I actually want this discount rate instead of the one that you're giving me.
That's a good question.
Is that how you?
I don't know that I'd put it that way, because that doesn't make me sound like I'm playing on a fair game. I probably what's more realistic is I might say, okay, here is my opportunity cost of capital. I know that as an investor, entrepreneur, whatever, I can get X. So I'm going to use that because I know it's the number I can defend. It's realistic, but it's not everything I want. It's just the one I can defend. For example, Brandon walks into a new employer, and the new employer says, "Well, Brandon, what are you making now?" And you don't want to tell him what you're making now, because you don't want to make what you're making now. So he says, and he knows you're making about $175,000 a year, and so he tells him, "Well, I believe what I need to accept your offer would be $250." You didn't answer the question, did you, Brandon? No. And you also know, and I'm using outsized numbers, you wouldn't give them a $75,000 spread. I don't think it's 175 or 200 are outsized. I think the spread is what was outsized. Okay. But you never want to just accept what's laying there. You want more. So can we say that we would manipulate the discount rate to justify it? Sure. Or we might just say the discount rate, all of our best guesses put us at $25 million. So I'm going to offer you 20. Actually, I'm probably going to offer you 18. And I'd be willing to go to 20, 21.
I just don't understand why they would accept it, knowing that the present value.
Oh, I'm sorry. So you have this really interesting company, don't you? I mean, it really is kind of
Of
cool.
course, yeah.
And it's been for sale for how long?
A year.
Yeah. And how many people have offered you a number that's even close to acceptable in that year?
Close to acceptable, not many.
Yeah. There might be a reason for this. It might be time to put on your big girl pants and just own up to the fact it's not worth it. I've used that term. So because these are very illiquid assets. The reason why there can be this big spread in between the bid and ask, even when we've got some more realistic numbers, not the kind you can drive a freight train through, that's still, might be a small percentage, but it might be $35 million spread, right? Which is not nothing. The reason why? These are illiquid assets. If they weren't illiquid assets, you'd have sold it a day. Well, in fact, you'd have gotten your money in your bank account a day after it went for sale. Not be having still conversations a year later.
So essentially that's what it is, it's the bid and the ask.
It's
that's why they're different.
Yeah, that's
Okay.
exactly what it is.
Okay.
Good for you. That's exactly what it is.
So when we talk about discount rate, is that the bid or the ask?
The discount rate is a number that is used to help us discount the cash flows over time back to today. So the future cash flows back to today. And your discount rate, if you are the firm, is probably informed by the firm's opportunity cost of capital, or WACC. Okay? And my discount rate, if I'm a potential buyer of the firm, is going to be informed by what I can realistically make on investments. And they shouldn't realistically be much different. Unless, as in the situation with Ariana, unless I'm gonna be doing something more than just providing capital. If I'm just cutting a check, right? Passive investment, then I have no real reason to expect that I can make a super economic profit. I have no real reason to expect that what I'm gonna get from this is meaningfully different than the discount rate that the firm is using or what its cost of capital. But if I'm giving money and some expertise, or money and relationship, or money and synergy, or we're gonna open markets in China, and if we're gonna have green energy, and if we're gonna use, I don't know what it was, I can't remember the other buzz term that always increases the value of the company.
Strategic something.
Strategic something, yeah.
Synergies.
Pardon? Yeah, with synergies, right? Yeah, okay, I did use it. So I'm gonna do all that because I want more. Okay, let's move on. Any questions with respect to the homework and practice homework? Good.
For the record, if you walk away after you take a quiz and do nothing, you can't take it again. That's what happened to me.
What do you mean?
I took the quiz, I submitted it,
Yeah?
I walked away. Went to food. I came back,
You couldn't take it again?
couldn't take it again.
Yeah, I don't think that's why you couldn't take it again. I don't think.
You only have one.
You only had one attempt.
Only the first one had two.
You only had, yeah.
Oh,
Yeah.
my
Like,
bad.
I answered this in an email to you, or maybe it was a WhatsApp post, I can't recall. So the first homework problem or set, I gave you 2 attempts, and I made a comment about this so that, because I knew you're just not used to them at all. Beyond that, you got 1.
Oh, my bad.
Yeah. No, you're not, it's not your bad. Okay? All right, should we move on to the new stuff? Let's review some other old stuff. Well, that's what we do. That helps us understand the new stuff. So I want to say that value, and value in this case is present value, okay? So whenever I say value or valuation, I'm talking present value. I am not talking net present value, ever. Is the present value of some discounted cash flows during our explicit period, plus the present value of some continuing value that we have somehow assessed. And I'm going to tell you that in virtually every one of the models that I'll be exposing you to or already have exposed you to, the present value of the discounted cash flow is virtually identical for each model. That only really differs in the adjusted present value model because we add something to it. This is existent, but another thing that looks a lot like it is existent also. Okay? This is our most basic construction. And I want to go back just to think about what the time sequencing looks like. If I'm thinking about this in real time, I have year 0, which is now, year 1, 2, 3, 4, and let's say I'm going to run my explicit period out to 5 years. And so I would have all 5 years in the discounted cash flow of my explicit period. So what do I have here? Well, I have a value as of year 0 that is a function of year 1. But that year 0 is right here. And year 1 is the next year, which we would think of in this time sequencing as year 6. But I don't want to think of it as year 6, I want to think of it as year 1, because it fits the convention of the equations that we use. Okay? So the present value of some discounted cash flow in all of our scenarios is going to be the sum of some of our free cash flows in years I, and years I in this case are years 1 through 5, okay, divided by 1 plus some discount rate to the t. And the t is the same number as the year that it represents. So there can be one of these for year 1, another one for year 2, another one for year 3, all the way through year 5.
And what does the I represent?
I simply means any. So the free cash flow for any year in our summation, okay? And we say that n equals 1 through 5. I don't know why we don't say I equals 1 through 5, but that's not the convention. I don't know why that is. Okay. So, but it's any of the years. So in this case, if I know that I'm summing up 5 years, I'll have free cash flow 1, free cash flow 2, free cash flow 3, and those 1, 2, and 3 are I. They're in.
So when we're looking at the spreadsheet, and we've calculated out, we see all of our cash flows, what number do we use to plug that in for that formula?
This?
Yeah.
So this would equal this.
It's a subscript just indicating the,
Yes, the sum of that cash
the
flow.
year in which that cash flow occurred.
Yeah, thank you. That I is not an operator. It's a descriptor. It doesn't do anything. It just helps you understand where it is and how to connect it to other things.
So
Does that help?
Yeah, so we have to set up the equation as many times as there are years in the explicit
Yeah,
period.
because this is a summation sign. I know it's a poor excuse for a summation sign, but that's what it's intended to represent. And it means we're gonna have more than one of these. And so we're gonna write them all down, add them all up. Okay? So what rule is there that tells you how many of them there should be? There isn't one. Whatever number of years is A, required to get the job done, and B, credible. What did Demoterin tell you the number of years that you should use is? Do you remember?
Was it 3 or less? Fewest number possible.
As few as possible. As few as possible get the job. Yeah. Which in the way that he looks at things, it is typically 3 or less. Right? That's right. So this is the basic construction of the present value of a discounted cash flow using free cash flow as the discounted cash flow. Is that a hand, Chris?
No.
Okay. And I've shown R here instead of whack. Why? Carlos, why? Okay.
Because you're trying to make an estimation of growth.
All of this relates to growth, but not expressly. I'm not expressly trying to make an estimation.
Is it-
Yes, Graham?
Is it because you're looking at it from the buyer's perspective?
Well, maybe I could be. So R is the general variable for discount rate. WACC is a discount rate. Hurdle rate is a discount rate. Investor return is a discount rate. Inflation is a discount rate. Interest rate might be if I had to borrow the money. They're all discount rates. So in using R here, I'm just generalizing. Okay? Maybe I'm going to use WACC. Maybe I'm going to use investor required return. It's just a discount rate. All that's intended to represent. Okay? All right. Well, then I need the continuing value. And the continuing value in the free cash flow model is free cash flow in time 1, not to be confused with free cash flow in time 1, right? So this time 1 is continuation time 1 over here on the right-hand side, divided by R minus G. Jenna, when I use this construction, can you kind of tell me what it's doing? What's really going on here? What is it I'm really adding up? Can anybody do that? Kim?
Is it your expected cash flow basically within the future?
When will that future be and or end?
It's unknown.
It's unknown, yeah. So literally what this is it's a summation. And I won't do the algebraic proof because you're already bored as it is, right? It'll make you only more bored. But it's a summation that takes free cash flow at year 1, that's continuation year 1, right? Divided by 1 plus R to the first, plus that free cash flow in year 1 times 1 plus G divided by 1 plus R to the second, plus free cash flow from year 1 divided by 1 plus R, 1 plus G squared divided by 1 plus R to the third plus free cash flow divided by 1 or times 1 plus G to the infinity divided by 1 plus R to the infinity minus 1. That's what it's doing. That equation takes a infinite series of values, which values are growing at a constant rate, okay? And divides them by 1 plus a discount rate to the power of the period in which you've got. And it's infinite. And it just makes a nice, neat little thing for us to calculate, and it actually does work, I promise. And instead of having to put together 100 of these, or 500,000 of them, or plus 1, plus 1, plus 1, you can just do this. So it is the future cash flows, because we don't know when this ends. And you might say, well, it's going to end when I have an exit and I sell it to Courtney's company. Well, it doesn't end, it just morphs into Courtney's company. It's not gone, it didn't die, it's part of Courtney's company now, right? Or it's going to end when I sell the steel for scrap. Well, if we know that, then we're not going to use this to identify our continuing value. We're going to use some other metric that tells us what this tonnage of steel should be worth at that point in time, right? Because that we do know finite. This is an infinite series of values. And then to find the present value of this continuing value, we're going to take the continuing value divided by 1 plus our discount rate to the t, which we know is going to be equal to times 0 for the continuing for the continuation period.
Why is that?
Pardon?
Why is that?
I love that question. Do you remember this equation, Kim?
Yes.
It's the most basic, right?
Right.
I mean, we learned this in really basic consumer and business finance. Some price at time 0 is equal to a dividend in the next period divided by a discount rate minus a growth rate. Okay? And this is, since this is what it's all built on, and this actually happens to work, okay? Then this was time 0 being a function of something that happened at time 1.
Right.
That's why.
Okay.
And we can say, well, continuing value, which is the continuing value at time 0, right? And since we know that that's what we're using here, we've got to discount it back to whenever time 0 is, or will be. It's not really 0. Yes?
I'm confused though. When you put t equals 0, what do you mean by that?
I mean,
Is it always going to be 0, or could it be like 5 here?
it's always going to be 0
Of the
because this is the 0.
of the
Now, it's not functionally 0. We're not going to actually have it to the 0 exponent. That's just telling us when we're going to find 0. In this case, it would be to the exponent of 5, right? Okay. But we generally we only know it's going to be t equals 0, and we need to figure out when 0 is. Well, 0 lives 5 years away
5.
from now.
Okay.
Yeah.
So
question.
that would be to the power of 5. in
Yep.
this
Exactly.
case.
Exactly. Why would we not put it to the power of 0?
Because you're discounting back to today and not.
Yeah, well, in fact, frankly, we're not discounting it at all if we did that, and we want to discount it back. Yeah, good. Okay,
Hey Rick, quick question real quick.
please, Lynn.
So last time we learned about the profit index and it says present value divided by investment.
Uh-huh.
But if we put that in, it's actually the value of DCF and continuous value, right? So I'm confused of why is there a difference between, or which formula would we use, the value or the PV? For
Value is PV.
value is PV.
Yeah. When I say value, I'm talking about the present value.
Okay.
Which present value is gonna be the sum of the present value of the discounted cash flows plus the present value of the continued value.
So that's continuous value, okay. Got
So so to make it a little plainer, I should do this. PV equals value equals those two things added together.
Okay, thank you.
Yep. So effectively what we're doing, this comes back to the questions you were asking, Marianne. Well, effectively what we're doing is we're creating a ratio of what we pay, of what was asked for the firm, perhaps, versus what we paid, right? That's the profit index. Present value of the asset divided by what we invested in. It's a ratio of what was wanted versus what was paid. If that's 1, that tells us something. If it's less than 1, then the other side of the table were better negotiators. Right? If it's greater than 1, yippee. That's a technical term. Okay? This is a free cash flow model. So free cash flow in the continuation term, free cash flow in the explicit term. Does anyone recall how this free cash flow model differs from the KVD model?
I'm gonna change the W.
You mean the discount rate?
Yeah.
Well, we would use, not necessarily, Chris, but I understand why you would think that. Because we might use the KVD construction from the standpoint of the firm using WACC. And I think I almost always show it to you using WACC, because that's just the firm's discount rate, okay? But we could use it from the standpoint of the investor, in which case it would be the required return. So that's not the difference. So there was another hand. Well, CJ, you started to say it.
Well, it has a different numerator based on no flat.
Which numerator? I got a whole bunch of numerators playing around here.
The continuous value. But then it uses the WAG is the growth.
Yeah. Well, that uses WACC is simply a function of what perspective we're looking from. Okay? It could just as easily use R, required return, H, hurdle rate, capital I, inflation, lowercase I, interest rates. It's just a discount rate, okay? Think about this. Do we have anywhere that tells us that free cash flow is equal to no plat times 1 divided by, or times 1 minus G divided by ROIC? Do we believe this to be true? Well, we have textbooks, theories, and material that tells us that's true, okay? And I actually can do a proof that will suggest it's true as well. You're about to see me do one in a few minutes. It's a simple proof, okay? This is one of the 2 real definitions of free cash flow, right? The other one is free cash flow is equal to no plat plus depreciation minus change in net working capital minus net capital spending. And in hearing that and seeing me write it, half of you thought, why'd you bother writing that? We've seen it 100 times. And you're almost bored with it, right, Ariana? No, not yet? Well, some of you are. Cam is. No, Cam, before you got here, they were extolling your virtues and values as their, well, frankly, as their real instructor rather than whatever schmuck kind of thing I'm doing. Okay?
No.
And you know what? I would get bored at that too. But I want you to think about where you are today versus 2 and 3 weeks ago with that. Okay? All right. So this definition of free cash flow in red is the one that we're always going to use except for in one particular scenario. When is that scenario? Well, okay, in the KVD model, but the KVD model using it at what?
Oh, when we don't have that information.
Well, no, we only use it in the continuation term. We only use it in a continuation term. Now that we don't have some of the information like change in net capital spending and change, or rather, we don't have net capital spending, we don't have change in net working capital as we're looking out into ad infinitum infinity. That's why we have to use it in the continuation term. Because we really can't credibly assess free cash flow in the continuation term otherwise. Kim?
So we use the blue free cash flow for the continuation period
And we use it expressly in the KVD model.
in the
Okay.
KVD model, but do you use like the present value discounted cash flows? Do you use the red FCF or you still use the blue FCF?
Red.
Got it.
We're only going to use this in the continuation. So here, for the KVD model,
This part of the problem.
what I've shown you in black is true. The present value of the discounted cash flow plus the present value of the continuing value. And the present value of the discounted cash flow is going to be the sum of free cash flows defined the way we would use the typical definition, which is in red over there. And it's going to be this summation. But then in the continuing value, we're going to change. So when we use KVD, which KVD stands for what, by the way? Key value driver. Okay, we have to remember that because it's relevant to the inputs. It's going to be equal to no plat at time 1, that's continuation time 1, not explicit time 1. Divided by, or times 1 minus G divided by ROIC divided by WACC or R, because WACC is just one of the many forms of R. WACC minus G. And this G and this G are the same G. They represent the long-run growth rate of the income variable at play. Okay? Same G. And when we're using G in a continuation term, which is the only place we're using it really, right? It's the long-run growth rate of the income term that's at play in the equation. But how different is this than free cash flow divided by R minus G? Isn't no plat times 1 minus G divided by ROIC, isn't that free cash flow? Is the KVD equation in formation really different than the free cash flow model? Wes?
So why, if free cash flow is the same no matter which equation you use, why would you use that equation as opposed to the one that uses net working capital and capital spending?
Good question. I don't have a great answer, by the way. That's why I'm stalling. But here's the best answer I can give you. Embodied in this, we have all of the very relevant inputs to the valuation discussion. Okay? And we know the valuation discussion, it has to do with ROIC minus WACC, or we can say ROIC minus R, by the way, because WACC is just one of the many forms of R, right? When this is greater than 0, growth creates value, right? And when it's less than 0, growth destroys value, and when it's equal to 0, it's impotent, okay? And we know that if we take and multiply our invested capital, which is fixed assets from our operation plus net working capital, when we multiply this by invested capital, we get economic profit, which is profit over and above that which we would expect based upon our discount rate. Super profit. When that's greater than 0, we be happy. When it's less, we're not happy, right? Because then it's economic loss. And that's a super loss. Not just a loss, that's a super loss. Okay? But it's suggestive that no plat, which is really EBIT times 1 minus the tax rate, is a key value driver in the valuation discussion. Growth is a key input to this. Return on invested capital is a key input to this. What's the equation for return on invested capital?
No five divided by invested capital.
Yeah. So in English, tell me why. No, you already, I promise you know the answer.
I mean, it's profit over the money that's being put into the company.
That's return on invested capital.
Yeah, so think about it. What is giving us our return is no plat, right? EBIT times 1 minus the tax. It's not free cash flow in this case, which is a little bit different because we've been using free cash flow all day long, right? So now we're saying that our return is measured by no plat rather than free cash flow. I'm okay with that because no plat is pure, right? No plat isn't tainted by capital decisions we're making. Either ones we've already made, equity and debt, or ones we're getting ready to make as to whether or not we're buying new equipment, investing in new processes. It's the purest measure that we've got that is still echoing some level of profit. So we want this to be as pure as we can get. Okay. Well, the only thing that differed between the free cash flow model and the KVD model was how we articulated free cash flow in the continuation term. That's it. Otherwise, they're the exact same model. And my guess is, when you calculate these in any given story, like the one you're going to do in the problem set that you'll walk away with today, you're going to get different numbers. You're going to get FCF equals something, and you're going to get no plat times 1 minus D divided by ROIC equals something else. And Mariana's going to come back at me and say, Rick, you told us they were the same thing. Right? Why are they different? Why will they be different? The actual easy answer is because we don't have a good, pure way of calculating G. Remember me telling you G was my nemesis? G, I kid you not. When I'm thinking about these things, I'm getting ready for something, G's what keeps me up at night. G's the one thing that makes me wonder if I've got this right. So a couple of undergrads and myself have recently finished an evaluation on a company in Utah County. And as it turns out, the company is actually pretty sophisticated. They know their stuff. And the CEO has been president of a couple of different companies. And so, you know, he kind of is sitting there passing judgment on us, if you will. Because he's not paying a dime for this. And the owners of the company are the ones that brought us in to do this. And he's trying to figure out why his numbers are so different than ours. And the answer is because he's assuming a growth rate that we just think is unsustainable. And we've explained why it's unsustainable. Do you remember from, I think, the math of value creation, IGR and SGR? Yeah, I didn't think you would. As it turns out, they're important, so we need to go back to them. IGR, internal growth rate, is equal to, I gotta make sure I get this right now that I'm being flippant.
Return on asset.
Yeah, ROA minus B, right? Divide, times B? Yes. Divided by 1 minus ROA times B, right? And ROA is net income divided by total assets. ROA is return on assets. And IGR, or SGR, sustainable growth rate, is ROE, or return on equity, times B, divided by 1 minus ROE times B. And B is equal to net income minus dividends divided by net income. Or B is the percentage of the firm's net income that they did not distribute to the shareholders. They kept as retained earnings. It's also called the retention rate. The inverse of it is the payout rate. when minus B is the pad. So if we are trying to interpret what's going on here, and by the way, ROA and ROE are big deals when it comes to measuring the performance of executives. Big deals. And ROA, net income divided by total assets, ROE, net income divided by total equity. Okay? And the board of directors is the one that decides what B is, right? Because they're the ones that decide what dividends are. And so, as the president of the company, or CEO, or just chief financial officer, you're kind of subject to a decision from the board as to what B is going to be, and you know that their decision in B, based on how much of the retained earnings they let you keep to reinvest inside the company, is going to affect your growth, right? If they don't let you keep any of it, it's hard to grow. If they let you keep all of it, it's pretty easy to grow. They're probably going to let you keep some percentage of it, 60, 70, 80, 50, I don't know what percentage. And your ability to grow can be measured this way. And if growth is a function of our assets, then the IGR is effectively our growth rate. It's the internal growth rate. And if growth is a function of our equity, then it's the SGR. So I think we just define a couple of G's, right? So I want to use them as that G, but I can't. It's not that simple. In part because this has to do with one given year, right? The year in which we have this ROA, which is going to be the net income from that year divided by the total assets that still exist in that year. And this B, which is a function of the board of directors' decisions at that point in time for that year. So even though I want to use these as a credible G, because I know that they're a credible G, I can't just do that. But what I can do is I can measure the G I'm going to use against them. So Chris, if you said that you want to see us have a growth rate of 11%, and Kim comes back to you and says, well, Chris, that's all well and good, but I got a problem because based upon the dividends that you've paid out to customers and what you've kept in retained earnings, I've got an IGR that's only 8%. I don't know how to do that unless you make some different decisions in the future.
Cut the dividend.
Cut the dividend. What's going to happen to your stock price, brother?
Go down.
Okay? But only momentarily. They'll come back. Okay? Dividends are really important right now and not important beyond that. Kim?
So would you be using your IGR, your SGR, or IGR, SGR if you were looking as like a buyer or more or less as a seller?
That's a great question. And I've never thought about it. So I think I would be thinking about it from both perspectives. This isn't an issue of my discount rate. This is an issue of what long-term growth rate I think the company can have. So I'm going to use it from either perspective, because either way I have to estimate the long-run growth, right? Or even the intermediate run growth during the explicit period. So I'd be utilizing it regardless. It's an input that I have to be aware of. It doesn't inform my growth rate, but it certainly could constrain it. Please.
So you use that to look at the long run growth rate and be like, that seems right, or no, that doesn't seem right.
Yeah, it's part of my intuition set, right?
Okay.
It doesn't help me, it doesn't tell me what number to use, it helps me understand what number I might think about using.
Okay.
Wes?
You continue.
No?
Okay. Because this is only 1 year, wouldn't it be better to look at kind of averages over time, or at least something along those lines? Because I feel like you could easily have 1 year where you have
It's an
massive
anomaly,
growth,
right?
and then you take all of that growth and then reinvest it so that the next year your growth is like 2%, but for greater long term, right?
So here's something that we don't really do in this class, but that you've intuitively understood probably needs to be done. And we don't break things into averages. we just look at each of these periods, okay? If you were taking, say, an extended version of this class, we would look at that. But if I'm thinking about ROA, and I'm using ROA to help me make a decision, I'm not going to just look at the last year's ROA. I'm going to take an average of the net income over the last 5 years, an average of the total assets over the last 5 years, and then I'm going to use those inputs to give me ROA, which is going to be my average ROA for the last 5 years, right? I'm going to take my B of the last 5 years as well. I'm not going to only use it for this. I'm going to use it for lots of my comparative measures, right? So I want to ferret out the anomalies. What if I don't think last year is an anomaly? Maybe I don't do that. Okay, so these are just two different types of growth rates that might help me inform what my G would be. Do you know another one? I remember that you know another one.
That's a rumor.
It's a rumor, okay. Well, it's a rumor that you guys evidenced on one of your problem sets, and the same ones in which you talked about this. And I think, right, investment IR times ROIC? That's what I was thinking it was. Okay? Well, this is going to suffer from the same problem. I mean, you know ROIC. What's investment rate? Do you remember?
Net investment divided by net
Very good. Right, no flat, right? So let's think about this. Why is that an investment rate? Well, the net investment is essentially, and that's not net income, even though it kind of looks like it, is essentially the change in our invested capital. And we can get more detailed about that, but we don't need to at the moment. So net investment divided by no plat, if net investment is a change in the invested capital, our invested capital changed as a function of our retained earnings as we then use them to buy more fixed assets and some function of depreciation, right? So we're coming back to our retained earnings and using them to help us grow. So it's the retained earnings adjusted for depreciation that we put into our fixed assets divided by what we made that year in a very pure way. Well, that's just an interesting ratio, right? And it would make sense that that would have something to do with our growth because our investment rate is going to then inform or maybe limit our growth. If our net investment is very large, then that means we used a lot of retained earnings to buy more fixed assets. And if we bought more fixed assets, then we better be growing as a company, right? Otherwise, why did we buy all these new fixed assets? Are they just to sit there and be pretty? Okay, which they rarely are. And then I multiply it by another return, which is return on invested capital, and you know again that that's no plat divided by invested capital. So that's another G, but if this comes from a particular year and this comes from the same year, just like the IGR and the SGR, then those can only be, they maybe are only telling me something about that 1 year. So that's kind of risky to use that to inform my long-term G. But if I do as Wes would like me to, and take some averages over time, then maybe that would help inform me. But is that going to be good enough all by itself? Why not, Brianna?
Are you talking about just the growth?
Yeah, why?
Just establishing.
If we wouldn't use just one of these, if we wouldn't use this for 1 year to determine our G,
Well, we don't know what happened in that year, so the G could have been completely different.
so we'll use an average of the last 10 years.
Well, depends on the type of the company, depends where the company is going, right? The G might be.
It depends on where the company's going. Does the last 10 years or 4 years or 37 years tell me where we're going?
Not necessarily.
No, it tells me where we've been, right? And there certainly is some path dependency. But is it only path dependent? Hopefully not. If so, I'm not sure why you guys are earning 7-figure incomes. Right? I know you are. Come on.
So, I feel like you're gonna arrive to a conclusion that G is just a guess number. Even though I'm totally kidding. But there's no right way to arrive at G. It's just guess it.
Yep.
It's actually all a dream.
Yeah, it's actually a dream. So this is why it's the nemesis. Okay? This is why it's the nemesis. Because I don't know what it is.
Oh, yeah.
But maybe, through this equation, I can figure out something. And I'm only going to take you part of the way down this road, and then we're going to finish that particular element next time, because I want you to think about it. If I have no plat times 1 minus G divided by ROIC, and if that equals free cash flow, and if I've calculated free cash flow from some other method and I know it, I believe it, I'm confident in it, then instead of solving for free cash flow,
Solve for G.
can I solve for G? I know no plat, don't I? Most recent period, or even if it's an average of the last 5 periods. I know ROIC, because there's no plat divided by invested capital. I'm just the income statement and balance sheet. I'm not being creative at all here. Free cash flow, income statement and balance sheet, no creativity. That's the one. Can I reverse engineer this lousy dog to tell me what this is? Sure I can. Well, to do that, I have to have some value in free cash flow, right? And once again, this does suffer from the same problem that those other ones suffered from. This no plat is a particular year. This free cash flow is from a particular year. ROIC is from the exact same year. I think the G that it gives me is actually just the G for that year. But we're going to extend this next time. I think it's next time. Into what I refer to as the G solution. If you go to one of those websites I showed you the first couple of nights, the multiples.rhaskell.org or models.rhaskell.org, and read about the G solution, it's really kind of cool. I think the G solution gives us an insight into the mind of the investors in the market. Okay, wow, we're just droning on about the free cash flow model and the KVD model. If you have the right G, then the same number. Okay. Let's talk about the APV model. How does it differ from any of the rest of what we've got on the board? So CJ's got a company, and the company has no debt. Would we use the APV model to value that company?
No.
Pardon?
No,
Why not? I mean,
it's not a highly leveraged company, and it's this formula is beneficial if your company is highly leveraged.
I don't know that it has to be highly leveraged, but it must be leveraged, right? Leverage
feel the
means
same.
there must be debt, and if there's no debt, there's no tax shield, there's no reason to use the APV model, right? And that's where the APV model has some uniqueness. So I've suggested to you that value using the APV model is the value of V FCF plus V tax. And V FCF is equal to the present value of the discounted cash flows, which are free cash flows, plus the continuing value, plus the present value of the continuing value using free cash flow of its cash flow variable, right? And V tax is the present value of the discounted cash flow using the tax shield as the cash flow variable, plus the present value of the continuing value using the tax shield as the cash flow variable. Please, Wes.
What was PV again?
Present value.
Or sorry, APV?
Oh, adjusted present value.
Adjusted.
We're adjusting our present value that we got from the free cash flow model for an additional cash flow. Which cash flow is the tax shield? Somebody explain to me what a tax shield is and why we might like it.
Reduces your income.
Gives you.
Say that one more time.
Reduces your theoretically, it reduces your income, but it reduces your tax liability.
Yeah, so the presence of debt reduces our tax liability. A reduction of tax liability, a reduction of anything, may as well have been a creation of something, right? So what's the tax shield? I think is probably a relevant question. The tax shield is the interest expense on our long-term capital debt times the tax rate on taxable income. So if I have some interest expense, let's say we had $1 million of interest last year, and we had a 28% tax bracket, I saved $280,000 in taxes that I would have had to spend if I didn't have that interest expense. Now, bummer, I had to have the interest expense, $1 million, or whatever it was, right? Bummer, but if I've got it, I might as well find the lemonade within that particular limit. Please.
What is interest expense again?
It's the amount of interest the company paid on their long-term capital debt.
Okay.
So if you had some bank loans, some bonds out, some mortgages, my interest expense is how much interest we paid.
Kind of like your mortgage interest.
Please, Courtney. That's the tax rate on taxable income. It's not the tax rate on EBIT. It's not the tax rate that we would see by taking our taxes paid divided by our taxable income. Why is it not the tax rate on EBIT? Why do we not use that?
Long-term debt.
Yeah, the tax rate on EBIT doesn't give, it has no echoing or hint of interest in it. We wouldn't use it, it's not relevant at all, okay? Why would we not use the tax rate that we can identify by taking the taxes we actually paid divided by our taxable income? Because the taxes I actually pay have nothing to do with my taxable income. They have something to do with that and the tax credits, my loss carried forwards, that the city of Payson was willing to give us some really interesting incentives to move our production facility there. They're not exclusively a function of our taxable income. So we don't want to then use that because of those other side things that may have nothing to do with the operation of the company really. Those are just happenstance, those are non-recurring, right? The problem. Okay. Well, if I want to think about this, and I'm going to create V-tax in the red pen here. I've already got VFCF, right? Same thing as free cash flow, the exact same thing. No differences at all. Same thing. But V-tax, is going to equal then the sum of the tax shields at time I divided by 1 plus K tax, oh my gosh, to the T, plus the tax shield at time 1 divided by K tax minus G divided by 1 plus K tax to the T.
What does K tax mean again?
That's the question. What's K tax?
Cost of tax.
It's a discount rate, yeah? It's the opportunity cost of us paying money in taxes, right? So, Lynn,
Yes,
when you pay taxes,
yes.
are you of the persuasion to think that taxes are just a sunk expense? You give them to the government, you just resent them, and we move on?
Yeah, I just pay it.
Okay,
No,
freaks you out, right?
Yeah,
You just want to go cuss, spit.
that's right.
Does anybody have a different opinion?
About taxes?
Brandon? Yeah. What's your opinion, Brandon?
My opinion, there's value to paying taxes.
And that's roads, parks.
Yes.
Do we have next roads?
They're necessary, you just need to know how to massage that system.
Well,
Other states or the other states.
Chris wants to argue that whether we get something from them or not, they're a necessary evil.
They are
I
necessary.
would tend to agree. Okay.
You just need to know how to massage the system.
Yes, and that's going to determine what you get out of it. But also, this is the only place where ideology comes into any of this stuff. My particular political ideology probably tells me whether or not I think I get something back from taxes of value or not, right? Okay,
Anarchy.
somewhere on this spectrum someplace, okay? And so K-tax is our opportunity cost of paying taxes, and it's probably informed by our ideology more than it is by numbers. Give me that hand.
So would the K-tax rate be the rate of which, wherever we fall in the income tax bracket?
No, not at all, not at all, it wouldn't be our tax rate.
Okay.
It would be, if I pay $1,000 in income taxes,
Mm-hmm.
what else could I have done with that $1,000 and what return could I have gotten on it?
Okay.
I could have put it in a CD at the bank, got 2.5%. I could have put it into some utility stocks, got a dividend of 4%, and some long-term growth, maybe another 2 point. But in this case, I gave it to some government. Those dogs didn't give me anything back. Or I gave it to some government, and I'm just grateful for what they give back to me.
They gave you
And-
non-anarchy.
Yeah, I'm really trying not to disclose ideology here, okay? Please.
This seems like it would be ridiculous. Do companies ever think of K-tax as what, I mean, in terms of, I'm a logistics company, my taxes help maintain roads, they gave me this value over this amount of time based on the amount of taxes that I pay. That, again, the calculation sounds like that would be immensely burdensome, but do companies ever play around with things like that?
Yeah.
Yes, yes, and yes. So you guys all know Overstock.com, right? They're a company that simply sells online products that real retailers couldn't sell, right? They have an economics staff of 13 economists, most of which would have PhDs. And all they do is work on this kind of stuff, right? If you're in a private equity firm and you're about to make a $500 million commitment or a $7 billion commitment, I promise you we're way past our HB 10Bs now. Way past. Okay? So yeah, but does the dry cleaner down in the corner, does the repair shop, does the office that's thinking about buying a new copier? No. They just don't have the bandwidth to do it, right? Doesn't mean it's not happening somewhere. Doesn't mean that the outcome of their decisions can't be seen that way. And if they can take the time, if they can pause to do that, they might be able to make better decisions. You guys will make better decisions, hopefully, because somewhere in the midst of a decision making, something's going to come back from this hellacious experience. And you say, oh, it was that. Yeah.
But, like, for me, the concept of that is sort of frustrating because there's like 1,000 things that you could have invested that money on. So how do you
Evaluate.
yeah, like how do you come to that number? Or is it just a number that they give you and I'll take it?
This is the hardest of the discount rates. Because this one's ideology. I know, it's not what you wanted to hear. It's not what you wanted to hear. Do you remember me telling you about the photograph I put up on the board, or on the screen, of the chimpanzee wearing a dress shirt and a tie and operating an iPad?
No.
So you
Yeah.
might not have been here that
maybe
night.
I wasn't here.
Yeah, so you guys, I think, hope to use all this accumulated knowledge you're getting in your MBA program to improve your incomes, right? Otherwise, I don't know what you're doing here. You could be out watching Arrested Development or walking around Sugar House Park or something, right? So you think you're gonna do that. And I'm gonna guess, and correct me if I'm wrong, that you would like to have a multiple six-figure income.
Bet your ass.
See, I love Chris's candle. I can always count it, always. Okay. But so far, Mariana, haven't we really only dealt with stuff that a monkey and an iPad could do as long as the monkey was trained to do it? Isn't it just pressing the right buttons?
I guess.
Kind of, right?
That
So
would be
what's
a
gonna-
very smart monkey.
Well, I'm not sure. I'm not sure. Because literally, my 2-year-old grandchild is able to use an iPad more fluidly than I am.
Okay.
Okay? All right?
Calculate the enterprise
Say what?
value? Can you calculate the enterprise value?
Probably just doesn't know it's an enterprise value, right? Knows keystrokes. Okay? That's why you train rather than teach. Okay? So monkeys and iPads can do a lot of what we're talking about. AI, right now, AI can do any of this. What can't AI or the monkey and the iPad do? Interpret. Which is why you're going to make some serious dough. Okay? All right, this is the APV model. Now, to be fair, I said that the VFCF was no different than this at all. And the reason I used R instead of WAC is because in the VFCF model, what is the discount rate? It's not K-tax, right? It was KU. It was KU. And KU, KD, KE, and K-tax are unique to this construction. And I don't really need you to know any more about them than that, okay? They are different forms of discount rates. We don't use WAC. We don't use WAC. But if you're doing problem sets that use these equations, which you will, I typically make a assumption, and that assumption is, I state the assumption, that WAC is equal to KU, KD, and K-tax for the purpose of manipulating this. So you don't have to go out and calculate what K-tax might be. And you're not just given some number that you think, wait, that's impossible. Because I have one opinion and Chris has a different one. Okay? What do you think?
Question.
Yeah?
Yeah?
I'm sorry.
Pardon?
Question.
Yeah?
So when you're using the APV model, it seems like the K-tax, like, would you use that to evaluate a firm? You know what I mean? So like, they could invest their money in so many things for like K-tax, or like we had talked about the unlevered.
Yeah.
Do you like just sum that all together? If you're looking at it from a firm perspective, because as like a small business, that seems like it would be a much easier number to come to.
So, I'm going to try to answer your question as I answer a different one, and then to connect them, because I think that's the only way I can do it to make it relevant.
Go for it.
Wow, I rarely have permission. So, even though the textbooks and the other written materials that talk about these kinds of things would tell you that a firm owner might use the APV model to determine a value, I would tell you never. Never. The firm should use the free cash flow model and or the forward market multiple model, which we'll talk about later tonight. Okay? The reason being is the firm's value from the standpoint of the firm shouldn't be any different based upon how somebody else is going to capitalize it. It is what it is, right? And if Wes is going to buy it 100% equity, and Chris wants to buy it 50% debt, 50% equity, and Lynn wants to do a massive LBO and buy it all debt with $1 in equity, that shouldn't make any difference to the seller, right? The firm. But if I'm the buyer, and I know what my capital structure is going to look like, I know what I probably am going to have to pay in interest, I know what my opportunity cost is of paying taxes, or I can think about that because I know my ideology, right? Then I might assess a value from that mechanism. And that might be superior for me than the free cash flow model, but only as the potential buyer. CJ?
So that, I mean, you're basing this on ideology, but I mean, if you're doing business in any country in the world, you're gonna pay taxes somewhere, right? So would your cost of capital on paying taxes be different based on where you have different operations and where you might choose to invest that money? You could have a,
I understand what you're asking.
disparity between
So if I live in Mozambique,
Mhm.
which has a very high personal and corporate income tax rate, I would look at this very differently than if I live in England, where the tax rates are minuscule by comparison. Why would that be? Why would I look at it so different? Is it because of the tax rates, or is there something else? Why are the tax rates so high in Mozambique?
Less resources.
No one pays the tax.
Nobody pays the tax. Yeah. Corruption is rampant, and the rule of law is irrelevant, right? They know they're not gonna get caught, and nobody does it. So it would be a very different thought to me, wouldn't it? Don't get too caught up on this issue of K-tax is ideologically driven. I'm not gonna be asking you to calculate K-tax. I don't think I'm technically even gonna ask you to use it, because I will define it as whack, okay? I'll say K-tax equals whatever whack equals, and just to kind of help you see a couple of things, all right? But just know that it's different and know a little bit about why it's different. And when you say the company can go out and invest in thousands of things, that's true always, right? But my opportunity cost of capital it's true of my opportunity cost of capital generally, not just a K-tax, right?
Yeah.
So I have to think about what I know I can get with investments. I can invest in this, this, or this. If they have 3 different rates, one of them maybe I believe, one of them I think is too pessimistic, one's maybe too optimistic. So I have my rate, whatever it is. And if I'm the firm, I know what that is because it's whack, right? And I calculated it in rates. Okay, let's take a brief break. We're not on trajectory, it doesn't appear, to let you out of here early, but we're going to. I know. Take a brief break.